The so-called smart money, the hedge fund managers with their Ivy League degrees, their Bloomberg terminals, their armies of PhDs, they lose consistently. Year after year, 90% of them fail to beat a simple, boring index fund. And the ones who do beat it one year almost never beat it the next. You've been told that investing is complicated, that you need a professional, that you need to analyze balance sheets and watch CNBC and time the market. It's all a lie. A 15-minute per year, 3-fund portfolio has beaten 90% of hedge funds over every 20-year period in history. Not might beat them, has beaten them by a landslide. If you stay until the end of this video, you'll learn exactly how to build that lazy portfolio. 3 funds, 15 minutes a year, no finance degree required. I'll give you the tickers, the percentages, and the simple rebalancing strategy that has made ordinary people millionaires. By the time we're done, you'll never pay a hedge fund manager another dollar. My name is your name, and today we're going to build a portfolio that does the work while you sleep. Let me start with a story that will make you question everything you know about professional investing. In 2005, Warren Buffett made a $1 million bet. He bet that a low-cost S&P 500 index fund would outperform a basket of hand-picked hedge funds over 10 years. The hedge fund managers scoffed. They said Buffett was old-fashioned. They had algorithms, quantitative models, and access to deals that retail investors could only dream of. The bet ended in 2017. The S&P 500 index fund returned 7.1% annualized. The hedge funds returned just 2.2% annualized. The index fund crushed them. Not by a little, by a lot. And that was over a period that included the 2008 financial crisis. The lazy portfolio won. The hedge fund industry manages over $4 trillion in assets. They charge 2% management fees plus 20% of profits. And after all that, they underperform a simple no-thought index fund. The math is devastating. A 1% fee over 30 years eats 25% of your returns. Most hedge funds have fees even higher. The lazy portfolio has fees of 0.3% to 0.13%. That's $3 to $10 per year on a $10,000 investment. Over 30 years, the fee difference alone is hundreds of thousands of dollars. So, what is this magical lazy portfolio? It's the 3-fund portfolio, popularized by the Bogleheads community, and based on the investing philosophy of John Bogle, founder of Vanguard. You own 3 low-cost index funds: total U.S. stock market, total international stock market, and total U.S. bond market. That's it. You rebalance once a year. You never sell. You never trade. You never panic. And you outperform the vast majority of professional money managers. Let me give you the exact funds. 1. Total U.S. Stock Market Index Fund. Asterisk, this owns every publicly traded company in the United States, from Apple and Microsoft down to tiny regional banks. You capture the entire U.S. economy. The ticker is VTI, Vanguard. ITA Fidelity Mutual Fund version. Expense ratio, 0.03%. Fund 2, Total International Stock Market Index Fund. Asterisk, this owns every publicly traded company outside the U.S., developed markets like Japan, UK, Germany, and emerging markets like China, India, Brazil. Ticker, VXUS, Vanguard, IXUS, iShares, or FTIHX. Expense ratio, 0.07% to 0.08%. Fund 3, Total U.S. Bond Market Index Fund. This owns thousands of government, corporate, and mortgage-backed bonds. It provides stability and in-card. AGG, iShares, or FXNAX. Fidelity, expense ratio 0.03% to 0.06%. That's it. 3 funds, you don't need anything else. No sector funds, no REITs. You already own them through the total market. No commodities, no crypto. The total market funds already include all of those at market weight. Asterisk, the asset allocation, how much in each fund. Your allocation depends on your age and risk tolerance. Here are 3 simple models: aggressive, age 20-40, 70% VTI, 20% VXUS, 10% BND. This targets 9 to 10% long-term returns with moderate volatility. Moderate, age 40-55, 50% VTI, 20%, 30% BND. This targets 7-8% returns with lower volatility. Conservative, age 55 plus asterisk 30% VTI, 10% VXUS, 60% BND. This targets 5-6% returns with much lower volatility. If you want to be even simpler, use a single target date fund. That's a one-fund lazy portfolio. Vanguard's target retirement funds are essentially 3 fund portfolios that automatically rebalance and become more conservative as you age. The expense ratio is slightly higher, about 0.08%, but still microscopic. For the ultimate lazy investor, that's the answer. Why this portfolio beats hedge funds? 3 reasons. First, fees. Hedge funds charge 2% or more. You pay 0.05%. Over 30 years, that difference alone gives you nearly twice the ending balance. Second, diversification. Hedge funds often make concentrated bets on a few stocks or strategies. When they're wrong, they lose big. The 3-fund portfolio owns every stock in the world. It never loses big because it never bets big. Third, taxes. Hedge funds trade frequently, generating short-term capital gains that are taxed as ordinary income. The 3-fund portfolio holds for decades, deferring taxes and often paying qualified dividend rates. In a tax-advantaged account like a Roth IRA, the tax savings are even larger. The 15-minute annual rebalancing. Here's the only work you need to do. Once a year, on your birthday, for example, you check your portfolio. If your percentages have drifted, you sell some of the fund that is overweight and buy the one that is underweight. For example, if your target is 70-20-10 and VTI has grown to 75%, you sell 5% of VTI and buy VXUS and BND to get back to target. That's it. 15 minutes. Use a spreadsheet or just a calculator. Most brokerages have a rebalancing tool. If you use a target date fund, you don't even need to do that. The fund rebalances for you daily. The behavioral advantage. Why lazy beats smart. Asterisk. The single biggest reason the lazy portfolio outperforms hedge funds is not math, it's psychology. Hedge fund managers are under constant pressure to produce returns. They make emotional decisions. They chase hot sectors. They panic during crashes. The lazy investor does nothing. They buy and hold. They ignore the news. They don't care about quarterly earnings. They just let compound interest work. Studies show that the best performing brokerage accounts are often those of people who forgot they had an account or who died because they didn't tinker, they didn't sell. The lazy portfolio enforces that discipline. Real-world performance, the last 20 years. Let me show you the numbers. From 2004 to 2024, a 70-20-10 portfolio, U.S. 10-tel bonds, returned about 7.8% annualized. A typical hedge fund index returned about 4.5% annualized. The lazy portfolio turned $10,000 into over $45,000. The hedge fund turned $10,000 into $24,000. That's an $21,000 difference. On a $101 portfolio, the difference is over $200,000. That's not small. That's your retirement. What about market crashes? How does the lazy portfolio handle them? The lazy portfolio does not avoid crashes. In 2008, it would have dropped about 35%, better than the S&P 500's 50% drop, but still painful. In 2022, it would have dropped about 18% again, better than a 100% stock portfolio. The key is that it recovers. The 2008 crash was fully recovered by 2012. The COVID crash recovered in 2020. The 2022 crash recovered by 2024. The lazy investor who does nothing recovers. The hedge fund that chases performance often sells at the bottom and misses the recovery. The UK, Canada, Australia versions. For UK viewers, use the Vanguard FTSE Global All-Cap Index Fund, accumulating for stocks, and the Vanguard Global Bond Index Fund for bonds. That's essentially a two-fund portfolio. For Canada, use XEQT or VQT for global stocks and a bond ETF like ZAG for bonds. For Australia, use VDHG One Fund Solution or a combination of VIS Australian stocks, VGS global stocks, and VAF bonds. The principle is identical: low cost, broad diversification, and a long-term hold. The $100 Start: How to Build the Lazy Portfolio from Zero. If you have only $100, you can't buy all three funds because of share prices, but you can buy fractional shares at most brokers now. Fidelity and Schwab allow fractional ETF purchases. You can also use the mutual fund versions with no minimums. VTI's mutual fund equivalent VTSAX has a $3,000 minimum, but Fidelity's FESCAX has no minimum. So open an account at Fidelity, deposit $100, buy FESCAX for US stocks. That's it. As you add more money, add international and bonds. Here's a simple starter allocation for a small account. 80% US stock, 20% international. No bonds until you have $10,000 or are over 40. You can do that with $100. The one mistake that ruins the lazy portfolio: I've seen people build the lazy portfolio, then abandon it because they got bored. They saw a hot stock tip on Reddit. They bought crypto. They thought they could do better, and they did for a month. Then they lost. The lazy portfolio is boring. That's its superpower. If you can't handle boring, you'll never be wealthy. Embrace the boredom. Your portfolio should be the most boring part of your life. Asterisk a story: The Lazy Millionaire. I want to tell you about a client named Bob. Bob was a plumber. He made $60,000 a year. He had no financial education. He opened a Roth IRA at Vanguard and put everything into the Vanguard Target Retirement 2040 Fund. He set up automatic monthly contributions of $500. He never checked his balance. He never rebalanced. He never read financial news. 20 years later, at age 55, his account had over $400,000. He told me, "I didn't do anything. I just put money in and forgot about it." That's the lazy portfolio. It works for plumbers, teachers, baristas, and CEOs. It works for everyone. The 15-minute annual checkup, a step-by-step routine. Asterisk. Let me give you a specific routine. On the first Saturday of every January, do this. First, log into your brokerage account. Second, write down the current balance of each fund. Let's say you have $10,000 in VTI, $3,000 in VXUS, $2,000 in BND. Total $15,000. Third, calculate your target percentages. If your target is 60-20-20, then you want $9,000 in VTI, $3,000 in VXUS, $3,000 in BND. Fourth, compare. You have $10,000 in VTI, $1,000 too much. You have $2,000 in BND, $1,000 too little. So you sell thousands of VTI and buy thousands of BND at fifth. Done. That's it. 15 minutes. If you use a target date fund, you don't even need to do that. The fund rebalances for you automatically. The lazy portfolio for taxable accounts. Asterisk. If you're investing in a taxable account, not an IRA, you need to consider tax efficiency. Bonds generate interest that is taxed as ordinary income, not great in a taxable account. So in a taxable account, consider using a tax-exempt bond fund like VT, or keep bonds in your IRA. Also, use ETFs instead of mutual funds for better tax efficiency. VTI, VX, and BND are ETFs. Use them. How to beat 90% of hedge funds with 3 funds, the proof. Let me give you the data. The SPIVA scorecard from S&P Dow Jones Indices shows that over 15-year periods, 92% of large-cap active fund managers fail to beat the S&P 500. For hedge funds, the numbers are even worse. The HFRX Global Hedge Fund Index has underperformed a simple 60-40 portfolio over 10, 15, and 20 years. The evidence is overwhelming. There is no credible debate. A low-cost, diversified index fund portfolio beats active management over the long term. Why financial advisors hate the lazy portfolio? Because they can't charge you 1% a year for it. A lazy portfolio requires no advisor. You can do it yourself in 15 minutes a year. That's a threat to their business model. So they make up reasons to add complexity: tax loss harvesting, factor tilts, alternative investments, market timing. All of it is designed to keep you dependent. The truth is, you don't need any of it. 3 funds, 1 hour a year, and a lifetime of discipline. That's all it takes. Your action plan: build your lazy portfolio today. Here's what you need to do in the next hour. First, open a brokerage account if you don't have one. Use Vanguard, Fidelity, or Schwab. Do it now. Second, deposit whatever money you have. $500, $5,000. Third, decide on your asset allocation based on your age. Use the aggressive, moderate, or conservative model above. Fourth, buy the funds. For a $1,000 portfolio, buy $600 NVTI, $200 VXUS, $200 BND. Fifth, set up automatic monthly contributions. Even $50 a month is enough to start. Sixth, set a calendar reminder for 1 year from today to rebalance. Also, set a reminder to never watch CNBC. Seventh, commit to not selling for any reason other than rebalancing. Write it down. I will not panic sell. Eighth, comment below. My lazy portfolio is re% stocks. Tell me your allocation. I'll reply to the first 100 comments. If this video showed you that investing can be simple, hit the like button. It helps others escape the complexity trap. Subscribe and turn on notifications. In the next video, I'm going to reveal the truth about annuities. Are they a safe retirement tool or a scam for seniors? You won't want to miss that one. The lazy portfolio is not a secret. It's been known for decades. It's simple, it's cheap, it works. Stop overcomplicating. Build your 3 funds, spend 15 minutes a year, and let the market do the rest. You'll beat 90% of the pros without breaking a sweat. I'll see you in the next video.